pressure despite such a big beat is because, in fact, the street is a little bit skeptic about what's going to happen in Q4. Europe, well, it delivered a loss, but no one was expecting a profit, so that was pretty much in line. The management told me as well that they're looking at losses reducing in Netherlands in Q4 from Q3, and from Q1 of next fiscal, it'll turn profitable. Debt number continues to remain stable. The management says, yes, we'll be trying to reduce the debt, but they didn't give me a number out there. And also they go on to state that they're going to be focusing more on organic growth rather than inorganic growth, and also the benefits of the expansion at Kalinganagar that will gradually come on stream for FY25. So you'll have volumes that will get a bit of a tail. I believe that they can sustain in Q4. Explains why the stock is down.
Okay, fair enough. Nothing wrong with the numbers, as Nigel is explaining. By the way, there's a guidance cut from Syngene that's flashing on your screen as well. So, as we're saying, a lot of the mid-cap earnings that have come in the last 24 hours, not exactly lighting up the house. However, let's focus on one that is relatively better off, and that's PNB. Those numbers were on our screen just a while back. I think we've got Abhishek with us. Abhishek, this is not bad, right? Asset quality seems to be improving. Loan growth looks decent as well.
Well, it's one of the best numbers on asset quality that you are seeing in last 8 to 10 years of gross NPA and net NPA ratio. In terms of the performance with respect to PNL, the NI is above our poll and PAT is largely in line with our poll. So a good set of numbers coming in from PNB Housing. Loan growth remains healthy at 14.5% YOY and about 3% sequentially. The deposit growth is the weak link over here, growing at just 9.35% YOY and about 1% quarter on quarter. The operating efficiency of sector, that is one of the best in last 5 quarters, coming in at 51.2% versus 52% sequentially. We have seen cost to income ratio rise for PSU banks on account of the wage provision revision that they have to make. Over here, the cost to income ratio has actually improved. There is sharp improvement in the overall asset quality. Gross NPA absolute value is down 7.9% quarter on quarter. Net NPA absolute value is down about 33% quarter on quarter. Looks like either they might have done write-off or sale to ARC, which might have helped in controlling or reducing the pain in the portfolio. Gross NPA ratio at 6.24% is the lowest that you are seeing in last 34 quarters. Net NPA ratio, perhaps over the last 9 to 10 years, it's the first time that I'm seeing it below 1% for PNB. Back to you.
All right, Abhishek, thank you very much for that. So that's PNB coming through. Syngene, by the way, has had its FY24 revenue growth guidance, as we just have been sort of reporting on it. Stock's not selling off more, about 1.75% down is what you have right now. Now, public sector stocks have been all the rage for the last so many months now. And even on a market which is down 200 points in the Nifty, that's the pack which is really charging ahead. Now, most of the interest, one has always assumed, comes from retail investors, small shareholders. But institutional investors, mutual funds are also getting behind this thing in launching schemes and attracting a fair bit of flow. Hormuz has looked at what institutions are doing and how many schemes and from which houses they're available. Hormuz, take it away.
So there are 4 such schemes that have been launched by fund houses that predominantly are focused on PSU stocks. Now, the 4 of them include the Aditya Birla Sun Life PSU Equity Fund, the ICICI Prudential PSU Equity Fund, the Invesco India PSU Equity Fund, and of course the SBI PSU Fund. Now, what has happened here is that there are some commonalities in all 4 of them. One of them being that of their exposure, of course, is towards equity. And I'll start off with the Aditya Birla Sun Life PSU Equity Fund. The AUM as of date is around close to 1950 crore rupees, and over the last 12 months this fund has returned 71% to its investors. Now, 91% exposure is towards equity, and the remaining 8% surprisingly is towards cash. So there is a cash holding there as well. Now, this is according to Value Research. Now, among the top 5 holdings, NTPC is the top holding with them, around 8% of their assets. Coal India is one, SBI is another, ONGC and Bank of Baroda form their top 5 holdings. Now, the interesting bit here is that SBI, despite being an underperformer, is one of the largest holdings in all the 4 schemes. Now, ICICI Prudential is the other one. The AUM around 2,000 crore rupees as well. Around the last 12 months, the fund has returned 61%, 91.6% allocated equity and 1.5% exposure to debt as well, and the remaining being a cash exposure. And here as well, SBI is the top holding. The last 12 months, India's largest lender has returned only 7% to investors, and yet it is the largest holding of this fund. 15% of their assets are allocated to SBI, and the usual suspects again, NTPC, Power Grid, Coal India and ONGC form the top 5 holdings here. The Invesco India PSU equity fund, it's the smaller AUM size, around 700 crores, similar returns, 62% over the last 12 months, 95% exposure towards equities and the rest towards cash. And here as well, NTPC is the top holding, and the addition here, the surprise addition here is HAL. There they have a 6.3% allocation of the total assets, and that stock has returned over 130% over the last 12 months. And lastly, the SBI PSU fund, which has an AUM of around 1150 crores, that has returned around 65% over the last 12 months. Around 97%, the maximum exposure among all the 4 funds towards equity is in this fund, and the remaining is towards cash. And as unsurprisingly, SBI is the major holding here, but the addition here is Hindustan Copper, which is 5.5% of the total assets. That stock has returned 120%, and BHEL, that makes an entry with 180% return, and it is 5% of the total assets of this fund. But surprisingly, neither REC nor PFC, 2 of the top performers of the Nifty PSC index, feature in any of these funds. Only 1 out of the 4 schemes has an exposure to PFC, and only 2 out of the 4 schemes have exposure to REC. So these are the 4 funds that are PSU focused, around 60 to 70% returns. The stocks have returned far more.
All right, Harmaz, interesting data there. And, I was hoping to see all these REITs and railway PSU stocks, etc., but it's kind of hard for them to be because we only looked at the top 5 or 6, right, holdings. So just by sheer weight, they'd probably, if they'd probably be somewhere lower down. But thanks very much. Interesting data on, institutional ownership. 4 funds, 4 PSU focused funds is what we have. Now let's actually listen to Sandeep Tandon. He's the founder and CIO of Quant Mutual Fund. They got into this entire PSU space some time back. Almost a year and a half out back. Got into PSU banks in a big way, paired their positions there, still invested in railways. They're kind of rotating out of, but still very bullish on the metals and mining theme. So PSU is still very much the focus there, with between 18 and 25% weight in many of their funds. Listen to a slice of this conversation.
So from India perspective, if I look at Prashant, the way right from 2023, I said that years belongs to neglected zone stocks, most hated zone stocks. If you really look at from a growth versus value debate, which keeps on happening globally, the cycle which started in August 2012, the growth at that lasted till September 2021. Okay, that cycle peaked out. After that is the value thesis which has come back. Now I'm not saying that entire move is going to be a linear move. Okay, within that you will see a cyclical up move or cyclical downfalls also. But our portfolio is now more pro value. Why I'm saying that? Because
which is hard assets.
Hard asset. Okay, we strongly believe that the perception which was there, okay, for these, if I have to, let's say in September 2021, there was a euphoria. And if you dissect the euphoria, you find the euphoria was in new age, technology company, growth company, not in value, not in infra name. So I think that
but we've come a long way from there.
Yes, but still, our view is that value as a thesis has a potential to last for a decade. It's a decadal view.
Wow.
Okay, and then look at the PSU moves. PSU is the classic representation of value thesis. They were beaten down.
Is that the highest weighted sort of space?
Yeah, for us is a very large weightage. We are relatively
if you're defined by ownership, would you say PSUs are your...
Yeah, it may be closer to, some schemes are 18 to 25% of that portfolio will be in PSUs.
Okay, and do the moves make sense? And we're talking about banks or we're talking about PSUs across the board?
We have banks also, but the percentage is very small as compared to 2 years back.
Okay.
Now, earlier 2 years back, the banks...
So PSUs ex-banks largely?
Largely ex-banks, ex-banks.
But there also, some of the moves have been phenomenal. Railways as a sector, there's defense as a space.
We have a large ownership in railway stocks in our portfolio.
And you're comfortable owning them?
Comfortable. Because you have to look at the thesis which you are bringing. When something gets changed, okay, when you say one perception of the most admired territory gets shifted, the shift, even let's say 10% of the money shift from admired territory or the most admired stocks towards value stock, the money is very, very large. Like when I say, let's say, why I'm slightly more cautious on US, we always say that developed market risk appetite has peaked out, okay? And liquidity will shift. So how money shift from high risk to low risk environment? If 10% of money shift from US to Asia and India in particular, there is tsunami out here. Something similarly, look at in last many years, last 10, maybe 1 decade, a large portion of concentration was confined to these admired territory stocks. If 10, 20, 30% money shifts from that territory to this value as a thesis or neglected zone stock, there is tsunami, okay? And we are already witnessing that phenomena happening. And where is the over ownership, okay? As compared to 2 years back, they were neglected, hated zone, but they are still not reached the admired zone.
But valuation-wise, I was looking at names like RVNL, etc. Now they're trading at 40, 45 times.
So I'm saying
earnings,
you have to do sector rotation, stock rotation. I'm not saying that one particular stock you have to participate. Like we were very early in PSU banks, we monetized that opportunity. Now we are somewhere else. So the sector rotation thesis, stock rotation thesis, you have to play to manage your risk.
But you're saying there is enough to rotate into.
Yeah,
because
enough
sometimes one feels that rotation तो हो गया अभी कहाँ rotate करें?
I will not take the name. Look at the top largest PSU companies. If you look at top 3 in terms of market cap, where is the ownership?
Right.
The largest public sector enterprise, the free float is 3.5%.
Not banks, right?
Not bank. It's not a bank. But where is the ownership? Okay. And so one of the large bank company available, not valuation-wise very expensive. I'm just giving example. And similarly,
ONGC and
they're Coal India, they're ONGC, they're LIC. Top 3 names are these 3 names you will get. Okay, where is the ownership in these names? On a relative basis, absolute basis.
Own all 3?
Yeah, we own all 3.
Okay.
Our portfolio is already disclosed, so we can talk about it.
And bullish about?
Yeah, we are quite constructive on this space. Okay. See, we believe mining, metal and mining as a thesis, which we started in 2023, I think will continue in 2024. PSU as a thesis will continue. So then you look at PSU and mining put together, and a PSU mining company will do as a theme. Then we are constructive on mining from a global perspective. We are very constructive. We think the mining
Hindustan Copper is something that you own in your funds.
Yeah, it is one of the large holding in our fund in a small cap. We bought at very early stages, but we are holding it for the last 3 years
and
now.
that came off a macro kind of a call.
Yeah, for macro call.
One name which you, I don't think have own in your portfolio is HDFC Bank. Or I mean, why is
no,
that?
it's not. Currently, we don't own it.
I mean, you used to own it.
Yeah, we used to own it.
But private banks is something which, I mean, the street is extremely bullish on. It has been bullish for a while.
Yeah.
But that has not worked for some time.
So this is the same answer I'll give you. If you look at the pure valuation aspect, valuation was attractive. Everybody was talking about it. It was a very consensus trade for a while. But if you start looking at the risk appetite data or liquidity analytics for the sector as a whole, then you realize some of these names actually peaked out way back in September 2022 itself.
When you say peaked out, you mean?
Reached out a peak. Okay, when I say peak out, not in terms of prices, like risk appetite was the highest between September 2022 till September 2023. So risk appetite has peaked out, which means there is no urgency to buy for anybody. Okay, liquidity cycle is actually shrinking. Okay, so if liquidity is declining, so it's a bad combination. See, other way, when liquidity cycle rises and risk appetite is rising, you make more money. When otherwise it happens, okay, so risk appetite peaked out, liquidity shrinking is a reverse combination. So that's the area we try to prune out. So we maybe what? I think overall we have only 3.8% weightage in the banking as a whole, in the entire portfolio, depending on scheme to scheme. So we are grossly underweight on the banking side.
And that has worked wonderfully well for you.
So far it's worked very well.
It has worked.
But again, it's a data-driven approach, not on the.
And if the data changes, you will.
We have no problems.
But as of now, it's not showing any signs of.
So if you ask me from a near-term perspective, maybe rallies can be there, but to take a decisive call, I don't think they have reached those neglected zone where we get like what was pharma in February, March, okay, or IT was in September. I don't think they have reached that phase where we will say go all out and increase the exposure. And again, it's a consensus trade, grossly overowned space. Okay, so we don't mimic indices. So we are very active money manager. So I look at industry closely. A lot of people look at closer to the benchmark allocation. We don't do that.
Got it. Is the market in fine shape, Sandeep, or you think we should be ready for a little more volatile 2024? I mean, ups, not just ups, which everyone is just used to, and some downs as well along the way. What's your sense?
So let me give you larger thesis. We have been saying India, this decade belongs to India, maybe half century belongs. Manufacturing as a cycle, larger thesis I'm talking about, looks very good to us. Anything, and again, so manufacturing is a very large thing, manufacturing, infra, as a space is doing very well. But again, as compared to maybe 2023 return, because everybody was very skeptical in the beginning of 2023, and obviously returns are far superior, you may not get something similar performance. But we are still very constructive on the entire India space. I have been talking about that we are in bull run, very decisive bull run. We are still in bull run. But easy phase of bull run is over.
So you crossed the 50% mark.
Maybe in certain sector, maybe certain stocks could be answer is. But if I have to look at summarize in the thing, I think maybe in 2024, at least I expect 24,000 Nifty. That's sort of minimum what I'm expecting this year. It's still a good growth in terms of return perspective, is a good number. I don't think we have seen a stage which is very classically euphoric, where we need to be worried about. But stock rotation, sector rotation is the thesis which we play, and that really help us in reducing our.
Okay, interesting chat over there. But let's talk about SBI Life. The stock has slipped 2% after reporting numbers. Yash joins in. Yash?
Well, Reema, one thing is very clear, that the problem around APE or premium expansion and margin expansion is a problem across the industry. But what I feel is that SBI Life seems to have handled both those issues a little better than HDFC Life and ICICI Pru Life. Speak about the top line, the total annualized premium equivalent. It's a slight beat when compared to the CNBC-TV18 poll. It's coming at about 6,130 crore. We were expecting it to be at 6,086 crore. It's up at a decent 13% on a year-on-year basis. Value new business, again, as I said, that those two problems have started impacting the numbers from here on. It's coming at about 1,680 crore. We were expecting this number to be about 1,722 crore. It's again grown at about 11% on a year-on-year basis. When we speak about margins, of course, margins have contracted. It's a miss as compared to CNBC TV18 poll as well. Margins have come in at 27.4%. We were expecting them to be at about 28.3%. On a year-on-year basis, they are down about 40 basis points. So, of course, the problems are there. Nobody can deny them. Companies are facing it difficult to expand their premium because of, the restrictions on the sale of high-ticket policies. The margins are not expanding because there's a higher demand for ULIP, which is a lower margin product. But still, as compared to HDFC Life and ICICI Pru Life numbers, SBI Life seems to have handled both these issues better.
Okay, all right, got that. Thank you, Yash, for the details there. That is SBI Life at the end of Q3. We will take a quick break on that note. Come back on the other side. We will tell you all about the buzz in dealing rooms today, and then get you some final trading ideas as well before the week closes out.
Well, take a look at the screen. It's 3 p.m. and we're getting into that expiry hour, and that explains why we're seeing a big recovery from the day's low. Pull up a few stocks. Hindalco has spiked up from the day's low. L&T, that's the larger weight in there. Big recoveries we're seeing. So pull up L&T and ICICI Bank. Both of them have seen a sharp spike up 100 points off the day's low. So there's a bit of an expiry-related factor that's played out here. And that's why the Nifty has done a quick 80 points as we speak. But a good time to get in, Nimesh. Nimesh, looking forward to that weekend, Nimesh. But tell us, what are you picking up in terms of dealing room chatter?
Well, Nigel, it's expected to be a volatile day because of the expiry. We have a truncated week as well. But, a lot of earnings have been disappointing. And that's been a key reason the markets have been dragged again in today's trade. Well, the financials look a bit weak, but contrary to the screen, I understand there is a bit of buying interest back in the private bank stock from the larger FISO. That's the overall sense from as far as flows are concerned. There was a large block in PNB housing, but that's largely like an internal trade, so it won't impact much in terms of the actual flows, so to speak, from the FISO. That's a bit of a clarification. And again, the PSUs continue to outperform. Select PSUs have done well again in today's trade. So that momentum in the PSUs continue, but I think the volatility is largely because of the expiry today. But again, in terms of earnings, only select pockets have done well. Largely, it's been a bit of a disappointing quarter in most of the sectors and stocks.
By the way, it's an interesting development on Zomato coming up on the screen. So Zomato has managed to get itself a payment aggregator license. Stock's a little volatile anyway. It's had a great run. I guess, Nigel, then what this means is that you can not just Zomato me some nice snacks for the evening, but Zomato me some money as well. But I don't know, it's a competitive landscape. You have a lot of payment aggregators already out there. So not quite sure how this fits in with their business plans. But that's interesting news nonetheless.
I think we'll just stay simple, go for a drink later, post the show. But let's get back to Nimesh. Nimesh, what are the stocks you're picking up in terms of news flow?
Well, Nigel, in terms of individual names, the first stock on my list is Sangam India. In a weak market, that stock is up 6%. Good volumes as well. There is a large block in today's trade. And I understand a single FI investor was a buyer in today's block, and some clutch of investors, including some HNIs, they sold in a block deal. So that's Sangam India. The second stock is ICICI Securities. This is interesting. That stock has seen, some bit of FI interest seems to be back in this particular stock. And remember, there is an EGM which is impending for a proposed merger with ICICI Bank. Given the kind of stock is trading at a premium now, looks like there could be some development as far as the merger is concerned. So that's the reason why ICICI Securities is buzzing in trade today. Third is a couple of stocks, both from the MSCI point of view, both BHEL and PNB. PNB, of course, the results came today, but BHEL is buzzing in trade, largely in anticipation that maybe the stock is going to get added to the MSCI in the Feb review, which will come on 14 Feb. So that's the reason why BHEL is buzzing. And the last one is Indiabull Real Estate. While there is a board meet for Indiabull Housing for a rights issue, even Indiabull Real Estate is buzzing, and the city is anticipating some corporate development in Indiabull Real Estate as well.
Nimesh, ICICI Securities, right? I mean, this is this has been a contentious issue for some time.
Yeah.
Anything else you're hearing?
So, Prashant, one of the feedback is maybe the merger may not go through because the minority shareholders may likely oppose the merger with ICICI Bank. If you look at the merger ratio, 67 to 100, which currently at this point suggests that ICICI is sitting at a premium to ICICI Bank. So, at least the market is perceiving, and the stock market is indicating that maybe there could be some question marks. Either the merger doesn't go through, or the merger ratio gets revised in favor of ICICI Securities. And remember, ICICI is the only stock in that broking space which has relatively underperformed in the last 6-8 months. Look at Motilal Oswal, look at even Angel One. They all have rallied pretty hard. Even ICICI numbers were quite good, but the stock has relatively underperformed only because of this merger issue. If that gets resolved and if the merger gets called off, maybe the street is anticipating that we could further see some re-rating in ICICI Securities.
Okay, interesting list as always. Thank you very much for putting the spotlight on that. By the way, the 3 p.m. expiry move seems to be taking place. The Nifty at 3 p.m. was below 21,300, and in a span of about 10 minutes, it's gained close to about 50 odd points. It's 21,350. The Nifty Bank too has seen a recovery of close to about 400 points from the session low. So trimming losses there. Names like ICICI Bank, Titan, L&T, Hindalco, these are stocks which have moved up as we speak. HDFC Bank, though, continues to languish under pressure. The improvement that we're seeing in banks is courtesy names like an ICICI Bank, and I think even an Axis Bank is seeing some bit of buying emerging. Nagraj Shetty is now with us for a few BTST calls, for the long weekend. Nagraj, afternoon. Thanks for joining in. What have you made of the price action today, the week, and what does it tell you? And any trades that you have?
Yeah, right now market is showing a weak trend. Even some sectors stock-specific action is continuing. On the index front, at the higher levels, I was discussing. Facing strong resistance around 21,500, 600 levels. A bit of recovery seen towards the end, and I'm expecting on the higher level we could see some selling emerging from the highs. And at the same time, there are some stocks showing some buzz. And if you look at the sale, the stocks has showed a false downside breakout recently and bounced back sharply in the last couple of sessions. And looking overall chart pattern is looking positive. I'm expecting this stock to move up further, and the next resistance to be watched is around 125 levels. This is the one which is showing some promising move in the during volatile broader market.
Okay, we've got the numbers out from JSW Steel. That first line on the PAT front looks absolutely robust. In fact, a significant handsome beat over the expectations. Tata Steel, remember, had a good showing as well on EBITDA on margins. And the start for JSW obviously is very, very positive. Stocks already moved up in positive territory. Right now, only have the profit line, and then we'll get to Nigel in a bit and discuss the rest of those earnings as well. But let's bring in Amrish Baliga into the conversation. Amrish, good afternoon. Thank you for being with us. Since we're on the subject of steel, and then I mean, good showing by Tata Steel and JSW, from the looks of it, it's looking decent, at least as of now. What would your take be on ferrous stocks, the large cap names?
No, I think the earnings have been, I suppose, hold on, have been going ahead, increase costs. So that could, but I don't see much of a downside. And at the same time, the steel as such, steel as well, in fact, rallying from here. So I would possibly hold in Tata Steel.
Yeah, Amrish, we'll just come back to you. By the way, we've got getting the other numbers that are up for you on the screen. So on the top line, it's more or less in line. The beat that has come in there is because I think of lower operational costs, and that explains why, if I saw that number correctly, on the EBITDA front, there's a good 500 crore beat out there, 500 to 600 crores. So I remember some part of the street was talking about this. Such a big beat on Tata Steel's India business. So the street was baking in that maybe the other couple of companies as well that have a similar mix should do well. And JSW Steel has a higher amount of flats. So that could explain why, in fact, that's come up higher. In fact, if you look at it, there's a good growth on the top line. And the power and fuel cost is sharply lower on a year-on-year basis. So that's one reason that's playing out there. And I think that's the primary reason why, in fact, we are seeing this big beat in terms of the EBITDA front. And that's why the margin number has come in at around 17%. We were working with mid-teens. Rakesh Arora of GoIndiaStocks.com joins us on the show. Hi, Rakesh. Well, the initial numbers that we have on the screen is top line more or less in line, but it appears the costs dipped more than anticipated. And that's why that's a beat out there. Your reading.
There's a little bit of lag between, raw material prices going up and or going down and being passed on. So I think that's where the beat has come in. But I think, going forward, steel prices are lower. Iron ore prices have moved up. Coking coal prices have moved up. And as Tata Steel was mentioning that, even in their results, almost 1,500 rupees per ton was just because of inventory gains. I think same is the case with JSW. And let's also not forget that JSW iron ore costs are much more linked to international prices. And they'll have a bigger impact getting into Q4.
Okay, we've got Abhijit Bora also joining in to react to the JSW numbers. He's from Sharekhan. Abhijit, you want to give us your initial take, and what would you advise on the stock now?
Yeah, firstly, we have a reduced rating on JSW Steel. In terms of the results, if you see the consolidated PAT came at around 2,450. Our expectation was around 2,100. So there is a slight beat in terms of the overall PAT. There was a slightly higher standalone EBITDA and also slightly higher, better performance from the subsidiaries. So there is a slight beat in the overall PAT of the company. We are waiting for further details.
Okay, all right. There are a couple of more details that we're getting up for our viewers on the screen. And the Bhushan Power and Steel asset, well, that's done quite well. The EBITDA number has come in around 780 crores. So, as Abhijit said, I think part of these subsidies as well have done quite well. As a beat, the costs have dipped more than anticipated, and you have some of the subsidies that have done better. Rakesh, it's almost market close, so final word from you before we let you go. Between the two, JSW Steel and Tata Steel, as well as SAIL and JSPL, what would the preference be? Both these two have delivered better than expected numbers, but valuation comfort, I think, is in the other two.
And also, Nigel, that, Tata Steel is slightly more consolidated and integrated for iron ore, where prices have actually moved up quite reasonably, even in India. As you saw, NMDC yesterday raised prices by 400 rupees. So I think integrated players would be better placed as compared to JSW and going into Q4.
Okay, all right, gentlemen. Thanks a lot for joining in and giving us those details. So the big headline that comes in there is that JSW Steel's operating profit is better than anticipated. A couple of the subsidiaries that have done well, and a couple of them, the larger ones have done well, because JSW quoted actually profitability on a sequential basis is a little bit lower, while on a year-on-year basis, JSW quoted's numbers look quite good. So the numbers are a beat, but sustainability of these numbers will be tracked. For the time being, slip in a short break, come back, count your focus on markets, and we'll take you through this expiry.
Okay, welcome back. You got the market, which is come up very, very nicely from the lows of the day, down 200 points now, about 120, 125 points off the day's lowest point is what we have. Amrish is with us. Amrish's pick today is life insurer, HDFC Life.
Yeah, Prashant.
Amrish, last time, the budget was a significant event for these life insurers, and not in a good way. Unlikely something similar will happen again, but why do you like this one?
Yeah, I think it's unlike to have anything negative in the budget this time, because end of the day, the budget, the main budget would be in possibly June, July, and this is more of a vote on account. Now, why I like HDFC Bank, basically it's the largest life insurance company, among the largest, and it has about 19.8% market share, and it's number 2 in terms of overall new business received premium. Look at the AUM, it's about 2.8 lakh crores, and the 13th month persistency ratio, which is one of the measures for life insurance companies as to how well they're doing, that's about 86%, which is quite decent. In fact, they have more than about 2 lakh agents, about 90 bank partnerships. And other than HDFC Bank branches, they have 500 of their own branches. The focus is on tier 2, tier 3 cities and towns. Q3 was anyway a bit of a disappointment, and that's why we've seen a correction in the stock along with the negativity which is there in the BFSI space, other than the PSUs. But I think this is an opportunity because look at the superior product mix which they have, a strong distribution channel. I think this will drive the growth going ahead. And we should remember that India is still a very underinsured market, about 3.2% penetration. And next 10 years, we will see the insurable population actually go up from 50 crores currently to about 100 crores in the next 10 years. So HDFC Life, I think, has that huge opportunity, and it quotes at less than about 2x embedded value of FY26. In fact, my expected EPS for 26 is 10.5. And with this, my target is about 750, which is a decent return for the current levels.
Amrish, I remember once chatting about Tata Elxsi with you. Company reported their numbers this week, a bit subdued, lower than street expectations. And the stock is expensive at 40-45 times for multiple. Now you're getting the stock about 8% cheaper this week, and from the beginning of the year by nearly 13%. So would you go out and buy it at 7,650?
Yeah, surely, because last time I think when we spoke, I had given a target which was close to about 9,100. It went to those levels. So those who had bought at that time, I'm hopeful they would have booked profits. I think this is again an opportunity to buy this at lower levels. And in fact, because of these earnings and possibly with the market correction, I'll not be surprised if we can get Tata Elxsi at closer to about 7,100 to 7,200 levels. So this is a buying opportunity. Again, it could be a wait of the next 2 quarters, but I suppose we'll again see those levels of 9,500 levels. So I think it's a great opportunity now.
Okay, all right, Amrish. We will have to wrap it up on that note. A little short on time today, but thank you very much for joining in and giving us the perspective on all the stocks that we've discussed. Well, the market is going to end looking not that bad at all. Imagine the Bank Nifty, which was down a whole 1.1%, has had a very decent recovery. So it seems to be springing to life, getting to this long weekend. And if I talk about some of the movers and shakers, just in the last half hour or so, the recovery is quite visible on stocks like, ICICI Bank anyway, better of the lot. Let's pull up some of the others as well. Pull up HDFC Bank, for instance. Pull up Axis Bank. Still in the red, but they've cut their losses, helping the Bank Nifty also pare down some of the red on the screen. Having said that, the red side does comprise of Tech Mahindra, weakest stock on the Nifty, 6% down. Cipla, which was losing some momentum after yesterday's big surge. And Bharti Airtel is the other one, which is down about 2.5%. Those are some of the big names on the Nifty. On the gaining side, Bajaj Auto, 5% in top gear. And how?
Well, ACC's numbers look very, very good, as we mentioned earlier on the show. And in fact, that stock popped up close to around 10%, goes home with a big gain out there. And it had a positive rub-off because Ambuja Cements as well was up close to around 7%. Remember, Ambuja Cements is the promoter of ACC Cement, so that explains why that stock is well run away. Now the street is looking through that. Maybe, in fact, both of them have got their act together. India Cements, well, it took heart from the fact that ACC's numbers are so good. The stock had corrected close to around 15% from the recent peak, but today it popped up in trade, so that did well. Nalco, overnight you had aluminium prices that were quite firm, and it's a PSU and it's in mining, so the street likes that. So that stock as well ends with solid gains. On the flip side, you had stocks like KPIT, Loris, HBCL, all of them under some pressure. But guys, I think what was important today was the Nifty Bank, second day running, went to the 200 EMA and managed to bounce off that mark. I think that's going to be a very, very crucial level on the Nifty Bank and in turn on the Nifty.
Well, there goes the bell, and the Nifty closes at 21,378, a 75-point knock on the Nifty, with the Sensex down 310 points. And just a quick tally of the week gone by, it was a truncated week. The mid-caps end with a cut of 1.7%, and the big drag has come in terms of the banks. The Nifty Banking Index down 2.5%, with private sector coming under pressure. But with that, it's a wrap on Closing Bell. Editors Roundtable comes up next.